This interview is brought to you by Midland Exploration, a dynamic and aggressive mineral exploration company focused on gold, platinum, and base metal discoveries in the province of Quebec.
Welcome to Cambridge House Live. I'm Vanessa Collette at the Toronto Resource Investment Conference. I'm joined by Danielle Park, author of Juggling Dynamite and the very popular blog jugglingdynamite.com. She's also the president of Venable Park Investment Counsel. Welcome, Danielle. Great to have you here with us today.
Thanks, Vanessa.
Danielle, you've expressed a lot of skepticism about quantitative easing. What is it about it that you're not such a fan of?
Well, because for someone who was aware of the credit crisis as it was building in 05, 06, 07, and was writing about it, talking about it, well before it sort of became popular lexicon, I was noting that the issue was there was too much debt in the world, that rates had been suppressed after 9/11 to 1% from Alan Greenspan's response, and that had really stimulated a lot of destructive behaviors, both in terms of reckless lending and reckless spending. So once we got to interest rates being 0.25 after the last financial crisis, you really had nowhere further to go. And so in a way, I thought that was a good thing, because debt couldn't be added to very greatly when rates had already been slashed to zero. But then the idea of quantitative easing was, wait, no, we won't let asset prices reset. We won't let consumers go back to healthy habits. We can drive them one more time to the brink if we just pump a bunch of liquidity into the banks. And it seemed like absolute madness to me. And I think, in fact, it is absolute madness. And what we've seen in the last 3 years is that tranche after tranche after tranche of madness has been delivered, and you have had a response, there's no doubt, in certain asset markets, certainly in stocks and to a lesser degree in bonds, but in terms of the overall economy and job creation and anything useful to real people on planet Earth, it really has done zero. And in fact, probably has created the backdrop for the next crisis, coming soon to us.
Absolutely. What do you think of some of the taper talk that's happening right now? There's a lot of rhetoric, but are we also going to see some action taking place? There's a big Fed meeting next week. What do you think is going to be the outcome?
Well, I think that tapering has to at least commence, because the political will to continue it. And in the Fed's own, fantasy, they have impacted the real economy. They would say that they see continued strength. The fact that they've overestimated GDP now 100% for the last 3 years really doesn't seem to faze them. I think it's interesting, Janet Yellen's been put forward as the front runner to follow after Bernanke, and she, unabashedly admitted a couple of years ago before Congress that she saw nothing coming when it came to the financial crisis. She listed the various derivatives and problems that led up to that and said, "No, I saw none of that coming." So to put our faith in the central bankers, who admittedly say, well, I don't see any problems, I never have, never will, it seems to me to be quite lunatic again. And so, we have this sort of minutia play going on. Everyone's distracted by who is going to be the new Fed, magician. And really what I'm tracking is what's happening in the global economy, how long we've been since the last cyclical low in both the economy and the stock market. And the answer is 4.5 years. The average expansion, average bull market is 3.7 years, so we're well past the average. In terms of the gains in the stock market, we're well past the norm. So I think, to think that this will continue indefinitely, whether the Fed starts to taper, whether they don't, I think is largely irrelevant. I think we're due for the next contraction, and I see evidence that it's already underway.
So you think investors should be taking precautions for, a collapse or coming,
It doesn't need to be a collapse. I mean, If you talk to a permabull, they will say that any kind of a bear market is an absolute disaster collapse. I say it's just the regular finish to every market cycle, is that you have a period of expansion and then a correction. This time, I think it has the potential to be of the 40 to 50% variety, just because we continue to be in a secular bear environment. This would be the third time that's happened in the last 13 years. We have leverage record use again back in terms of margin debt in the world, right back to where we were in 2000, 2007. So I see a lot of the same culprits and players talking the same stuff, and the risk-taking has been pretty extreme for those who have been participating. And certainly there's been a lot of people who have kind of been twice burnt and stepped back and said, this makes no sense to me, and therefore I'm not going to play this game of cards. But there's others who have been just, swinging for the fences, and I think that in the fullness of time they will get their just desserts, as always.
Right. So you're saying a contraction is a natural part of economic cycles, and should the government just let the economy contract, pull back on their intervention, and that would solve the issues?
Well, it's human behavior. So how do we solve human behavior? I have no idea, Vanessa. It's been like this since, thousands and thousands of years. But I think that, to think that there's an incredible hubris to think that a central bank or a government or any politician can stop in and change the historical pattern that has always been there. And it's driven by too much confidence, too much leverage, putting prices too high, then reality disappointing in the face of those high expectations, a correction phase which brings things back to reality, which reveals value, and then you get people interested in deploying capital again. And so since 2011, certainly we've seen the commodity cycle turn down again. We've seen emerging markets turn down again. We've seen the Canadian broad market. Let's face it, it's still down, some 9% from 2011 and 17% from where it was at 08. So the idea that stocks perpetually go up is just untrue. We've certainly seen outsized gains in the S&P in the last couple of years with each minutia of QE, but I think that is not long for this world. And the other thing is that every cycle the Fed steps in to stop it. Every cycle the Fed starts slashing rates. But in prior cycles, they've had some meat on that bone, right? They've had rates at a more normal level, 5.5, and they started bringing them down to try and resume consumption. This time they're already at the ground. They've already, prostrated their balance sheet. They're almost $4 trillion of interest rate exposure now. So really, I think it's enough said. They should just, they've tried their best apparently, and I'll give them credit. Maybe they thought they were doing something good. But I think it's time to just sit back and let some actual economic momentum take over.
Right. So how does, this potential taper affect the gold market?
So the gold market is an interesting one as well. Certainly it topped in 2011. I think there's two potential theories here. One has been my main thesis, would be that the gold market really topped with the commodities bubble and the credit bubble in 2007-8. And it had a rebound when they started the QE because there became a new belief phase that governments would do this indefinitely and that it would create a great deal of inflation. Well, 3 years later, they've continued to do it pretty indefinitely, at least so they would say. They're going to do this until whatever it takes and all that stuff. I think, though, we're coming to the end of the appetite for expanding. Maybe status quo will remain for a while, but to add more QE at this point is unlikely. And you still haven't seen the resurgence in gold and silver prices. So I think that the bulls in that camp have some splaining to do. And I think that investors, human behavior again, Vanessa, are losing patience. I think you've seen that with the gold mining companies, for example, have gone from, the index was something like 26 to 9 roughly. So we've had a huge reconciliation of those really, animal spirits in that sector. Now, what happens from here is anyone's guess. It's possible that QEs will not continue infinitum and that we will see a correction in the overall markets, in which case some of the precious metals may also get sold in a liquidation type environment. But obviously price risk is probably less there than it is in things like interest sensitives today, or the S&P, the broader indexes, which are at nosebleed levels. So again, if you make me pick, if I have to deploy capital into equities today, I would want to do it into things like some of the emerging markets, some of the things that have been beaten up rather than the things that are at record highs. And I continue to believe that people have to look at this next phase from a value investment perspective rather than a speculative capital gains perspective. And on that front, precious metals has some problems as well, because if it's not going to go up perpetually, then people are very likely to not be patient and just hold it for years in the hopes that it's a hedge against something that they're not sure in particular. Since there's no income generated, I think it may have a tough hoe to climb here if we're not into the hyperinflation period that everyone's been predicting,
right,
even for a few years. I don't think patience will make most people hang on that long.
So are you still seeing value in this sector?
I don't particularly see much value there, and I haven't for the past few years. But you know, I remain open to the prospect. I mean, there's some who argue that, you know, the collapsing dollar will drive everyone into precious metals. Unfortunately, our work on the dollar has suggested it was in a bottoming pattern back in 2011, and it was in an expanding pattern and has been ever since. Again, not saying it'll go on forever, but these cycles tend to be several years in length. And I think so long as the US dollar is strengthening, so long as QE is less or tapered, I think that you're going to see strength in things like US treasuries, US dollars, and probably weakness in all the interest sensitives. So things like bank shares and utilities, where everyone's sort of been driven in the last few years.
Right, seeking stability and, you know, flight from the risky environments we've been in.
And income, right? Everyone's been driven there. Again, the zero rate policy has made people do reckless things. I don't know that everyone appreciates how reckless they've been. I think some are in denial or just don't appreciate. They've reached for yield thinking it's a defensive sector. But you know, the defensive sectors are looking very, very dangerous in our work right now. And so that's what I think, you know, people have to be so careful that they haven't just been sold a bill of goods or bought a bill of goods thinking there's stability where there is none.
Absolutely. You said something I found fascinating about, you know, Australia and Canada having squandered the mining boom. You know, what would you want to be in place if there's a next, you know, coming up cycle?
Well, because it's like every person who suddenly comes into rapid revenue growth and wealth, it's back to the human dynamic. What we tend to do is ramp up spending and ramp up risk and extrapolate, you know, growing trends into the future. And so we don't typically plan for the rainy day. We don't typically plan for the pullback in the earnings picture or the revenue cycle in the stock market. And that's been Canada with a vengeance in the last few years. I mean, look at who the biggest and brightest companies in the world in the resource sector, for example, in 2008, were attracting the biggest, most well-paid CEOs from all over the world, and Canada was feeling quite cocky and sure of itself. And then since then, of course, we've been quite a disappointment to many people, and our currency has not gone back to 110 and beyond. It's back below, you know, 96 and weakening and negative trend. So I think it's just, again, what we need to do is understand the full nature of the cycle and pay down debt when things are going really well. Look for price appreciation that looks unsustainable so you can take some profits off, put some liquidity aside. And as far as the political interests in the country, it seems to me that we have to become more than just a hardware store. People will say, oh, we have this vibrant financial sector, but actually the vibrant financial sector is really there to support the resource sector. That's really what feeds off of it. So our services are very dependent upon that hardware store component to our national product. And so I think that an intelligent way to go about it would be to develop second-tier companies as well, so that you're making more stuff here in Canada, supporting jobs in Canada that are not so developed, so dependent upon, you know, who's buying our rocks and trees. And I know it might be easier money to just sell the rough product, but really it's not investing in our country, it's not diversifying our business model, and it's not really building the strength in our workforce. And I think the biggest thing overhanging all Western countries today is the demographic problem between the aging boomers taking tons out of the system and an underemployed, you know, in many ways unequipped younger population coming along. We really need to figure out how to go back and pick those people up. And the way that we do that is to invest in training, new business ideas, you know, incentive to education in the right areas, not just general education for education's sake, but actually training the workers of the future so that they can come and help pull the cart, so to speak. So I think, you know, this is our opportunity. We've had our comeuppance, and I always say, you know, pain can be painful, but it can also be very useful if you learn from it and evolve your behaviors going forward. It could be, one of the best things that's ever happened to us.
Oh, great. Well, thank you so much for joining us today. Danielle, it was a pleasure having you here with us.
Thanks so much.